Strong earnings and a better-than-expected jobs report helped stocks bounce back today, with the Dow Industrials finishing up over 400 points. Now, financials in particular were strong. One of those was independent investment bank Evercore. That company up more than 3% after dropping almost 10% yesterday. Joining us right now to talk about really the macro environment is Evercore CEO Ralph Schlosstein. Ralph, good to have you here.
Thanks, Carol. Pleasure to be here.
It is a crazy market. You and I were talking before we got started. What do you make of these significant swings that seem to hit us on a daily basis?
Well, these swings, whether they are up or down, are a sign of an unhealthy market, a market that is extremely nervous about exogenous factors that could drive values down, or if they are removed, could let the market come back up to what a more natural level for the earnings that we are expecting.
It's interesting because we have folks coming on saying, hey, great value out there. This is a great time when we see a down day to be out there buying. Do you share that perspective?
I think if you look by any traditional measures, the multiples of the S&P, the earnings yield, and particularly relative to fixed income instruments, stocks are cheap. But you have a couple of big clouds that are hanging over the market. Europe is clearly one, unresolved. And that could have a powerful effect, just like we had a powerful effect in 2008 and 2009. And then the second one is we've had a lot of uncertainty in the last month or two, and no one really knows what the effect on the real economy will be from all of that.
And then we've, of course, got all the wrangling in Washington. I call it the triple play right now because it seems like wherever you look. It's interesting. You said we're not sure in terms of Europe whether or not that results in what we saw in 2008, 2009. Do you think investors should potentially be setting up that we could feel the same dramatic moves, declines, impact that we got in 2008, 2009?
Well, you have a few, but not all of the ingredients that you had in 2008. You have a large asset class, sovereign debt, which is not perfectly priced right now. People don't know what its value is because it's not clear that they're going to all be money good, although that should be the result.
Right.
You have an undercapitalized banking system in Europe, which owns a lot of this debt. And you have a highly fragmented political process. I think most people who watch this have a pretty clear idea of what needs to happen, but getting from here to there, as we saw in TARP in 2008 and as we saw just now in the deficit process, is not easy.
You say getting from here to there. I mean, you're right. I mean, do we need, I don't know, what some kind of crisis at this point to get to that solution, the needed solution in Europe?
Well,
it feels like we've had many crises along the way.
Hopefully, that will not happen this time. Unfortunately, we seem to, our politicians seem to enjoy putting us through that before they do the right thing. And that's not to say it's not difficult in Europe, because you have, some very well-off countries that are being asked to pony up to help those that have been a bit on the profligate side in order to preserve the euro. But there's some big things that need to happen there.
You guys at Evercore, you advise institutional investors. You have high net worth individuals. I'm just curious, what are you telling them at this point? Do you hold off until the dust settles at this point, which could take some time?
Yeah, I don't do that day to day for a living, but I think the stock market is down almost 15 to 20%, depending upon whether it's the beginning of the day or the end of the day. And that's not a time to fundamentally alter your long-term commitment to equities.
So ride it out.
That would certainly be my view. And if anything, as others have suggested, I think today, it's a good time to add to very high-quality names.
Ralph, you've worked in government as well. I mean, in terms of the super committee being named, I mean, are you anticipating that we're going to have another crisis situation in D.C. come November, December, as they try to figure out what's the next step here?
Well, this is set up so there isn't going to be a real crisis like, will we pay our debt, which was a pretty remarkable exercise to watch.
And that we're still dealing with.
And which we are still dealing with to a certain extent. But the truly disruptive thing, the U.S. not paying its debt, is off the table at this point. So it's really a question of the quality and the size of the deficit resolution that we have.
Do you anticipate that we're going to see revenues back on the table here?
Well,
we hear the president talking about it today again.
I think I said here yesterday, I believe in the 4 Bs, what we need. Big, $4 to $5 trillion, balanced. Everybody talks about balance between revenues and expenses, and we need that. But we also need balance within the expense category between entitlements, which need to come down,
right, and
investments, infrastructure, education, R&D that will make America competitive. The third B we need is back-ended. The economy is flat on its back right now. So we need the reductions to be in the out years so we can keep the economy growing. And finally, it needs to be bipartisan. That's probably a 3-corner shot in today's world, but we certainly should aspire to it.
Ralph, let me ask you about the bipartisan part. I was just over in Germany for a few days, and Europeans were really disgusted with the political situation in Washington. Interesting, because they just continue to kick the can down the road there and are bound to run into some serious problems of their own. The bulls, the optimists here in the U.S., say that the democratic process is working the way it should. What do you make of how it's going in Washington?
Well, there once was a phrase that the 2 things you don't want to watch is a law being made and sausage being made. I think today all of us would rather watch sausage than laws, given what we've observed in the last month. We did get to a final result, but it was not a pretty process. I think if you're an optimist, you would say it was a disappointing process. If you were a pessimist, you might use a stronger word like disgusting. But in either case, I think we got to a decent result, and I think Europe needs to do the same thing.
Hey, Ralph, one story that we've all been reading big time is about Ken Griffin, and said to be getting ready to sell his investment bank, shut his equity research group. What do you make of that development? Because when he started, he was pretty enthusiastic and planned to achieve a lot with it.
Yeah, I think the idea that a startup investment banking firm, full service, capital markets, investment banking, underwriting, secondary trading, can start today or a year ago or 2 years ago and compete with the very large firms that have been in this business for decades and have tens of billions of dollars of capital is not a bet that I would make. I think it's a very, very hard thing to achieve, and I think the announcement today is a recognition of that and a validation of that.
Was it surprising or not necessarily in your view?
Well, I don't follow what they're doing day by day, but in the broad scheme of things, if you asked me, could you start an investment bank in 2008 and 2009 and go head-to-head with the large firms with all their capital and all their talent, I would have said I wouldn't have bet on that.
But Ralph, you don't think it's representative then of a trend that the boutiques that started off in the crisis with a lot of the bankers that were fired in 2008, 2009 are not doing well?
Well, I think there are independent investment banking firms like Lazard or ourselves or Greenhill who, to the best of my knowledge, didn't hire anybody who was fired by anybody. We've tried to take the creme de la creme of the talent, and we have very successful models or businesses doing that. I think it's important to note that we compete in a teeny part of Goldman Sachs and Morgan Stanley and JP Morgan's business. The advisory business, particularly, that represents in the firms that are huge in advisory, like Goldman, maybe 4 or 5% of their revenues. Most firms, it's 2 or 3% of their revenues. Citadel went out and said, we're going to compete in 100% of your businesses. That's pretty hard to do.
Ralph, what do you think of the financial services industry, though, overall? Because we're seeing more and more headcount reductions, and there aren't any of these smaller boutiques opening up to pick up these guys. Headhunters are telling us there's nowhere to go. It's just Dodd-Frank is making this a smaller industry.
Well, I think the combination of the Basel capital guidelines, the higher capital guidelines we have already, plus Dodd-Frank, has clearly reduced on a permanent and fundamental basis the return on equity in these large balance sheet oriented institutions. And I think step one is going to be an attempt on the institution's part to redraw the line a little bit between the employees and the shareholders to try and bring that return on equity back up. And that will be done in two ways. It'll be done first by headcount reductions, and second, I suspect it will also have an impact on compensation in those firms as well.
You know, Ralph, we started off by talking about what's going on in the markets, and I'm curious for your advisory business. I mean, are companies getting so nervous that they're holding off on doing any kind of deals moving forward at this point?
Well, we haven't seen that yet, and I emphasize that because, we're really 2+ weeks into this volatility.
Feels longer, but you're right.
And we're in the middle of the summer, so. If things calm down and we get these clouds off the horizon, I think the recovery that we started to see in M&A pretty robustly continues. If we go through a multi-month period of time like the last 2 weeks, we'll have something not dissimilar from what we had last year, where we had a little pause in the pace of pickup in activity.
Going to leave it on that note. Ralph, thank you so much.
Sure, my pleasure.
Ralph Schlosstein, he's the CEO of Evercore Partners.